So again, welcome to the HARP 2.0 Frequently Asked Questions webinar. I'm your host, Todd Bookspan, and I'm a certified mortgage planner at Cobalt Mortgage. I'm the host of Real Talk Arizona, which is on the Patriot 960 AM today, Saturdays at 2 to 3 p.m. And really excited to be walking you all through this today. Most people are asking me, why am I taking so much time? And I've really applied a lot of energy to the HARP 2.0 program. And it's really because our team vision and my personal motto is that I'm dedicated to rebuilding our housing and credit market one family at a time. And I believe that HARP 2.0 actually may help. I've been kind of a badgerer of previous government refinance programs, but I think HARP 2.0 actually gets just about all of it right. So again, today this is going to approximately 30 to 45 minutes. If you guys have lots of questions, I have a feeling it'll probably be a little bit quicker than that. And then as we go through, like I said, we will hold questions and answers to the end unless you just have some burning question. And really my goal is to give you an overview without being too technical. There's all sorts of real technical downloads. I've got some links at the end if you really are excited and want to bore yourself with the little details. So you'll be able to go check those out. So we're going to go through kind of in this order. What is HARP? What loans qualify? What borrowers qualify? Of course, the most important question everybody wants to know, which is rates and other frequently asked questions, and then what to do if you are or are not eligible. So what is HARP 2.0? HARP 2.0 is the Home Affordable Refinance Program, or HARP, and it's designed to assist homeowners in refinancing their mortgages even if they owe more than their home's current value. And so that's the real key, is that even if they owe more than the home's current value. The current program, HARP 1.0, was limited to 125%, and ultimately now they've eliminated that piece. There's two versions of it. There's the Refi Plus version, and there's the DU Refi Plus version. And the Refi Plus version is a manual version. They're actually being currently done. It's a servicer-to-servicer loan, meaning that if your loan is with a Wells Fargo, for instance, then Wells Fargo could do a manual underwrite and do that loan into Wells Fargo. And then really the one that we're focused on that I think you're going to find the majority of the industry doing, which is the DU Refi Plus version, which is an automated underwriting version. It's going to be the low doc version and the one that most clients will want to participate in. And I'll go into details on how that process will work towards the end of the webinar. So again, DU Refi Plus may be originated by any lender selected by the borrower, and so that's the real key. Most people are concerned about who can do this loan, and it's really anyone they choose that's a participating lender in these programs. Refi Plus is for loans that don't meet the DU Refi Plus guidelines, and as I mentioned, are limited to the originations by their current servicer of their existing loan. So the big question always is what loans qualify, and it's loans owned or guaranteed by Fannie Mae or Freddie Mac prior to June 1, 2009. And so that's, probably the one thing I don't like about the program, and the only real complaint I have is that it's from loans prior to June of 2009, and Fannie and Freddie have their reason for it, and I don't necessarily think you would agree with why they're doing it that way. But the bottom line is that they don't believe that loans after that have been subject to the declines that other loans have been subject to. And they also believe that the loans after that date have been underwritten to stricter loan guidelines. So it is what it is, but ultimately that's the one flaw in the system. They have to be originated between June 1st of 2009. As I mentioned, the number one thing about this is that there's no loan-to-value or LTV restriction. Unlimited loan-to-value, which means that it doesn't matter how far underwater a borrower is, they can refinance their loan if their loan is an eligible loan. So if someone owes $1 million, well, they really wouldn't have a Fannie Freddie loan for $1 million, but let's pretend they did, and their loan was worth $50,000, it would still be eligible under this guideline. By far the thing that everyone was waiting for, and unfortunately it was done a little too late, but bottom line is it's a great opportunity now. So in English that means there's no appraisal, and that's what everyone wants, is something they don't have to worry about where their value is. Not only does it make more properties eligible, but it's also a cost savings. So what borrowers qualify for this program? Really, there's three things that everyone's been asking me about, and that's employment, credit, and occupancy. So I took this straight out of the guidelines on employment. The lender must obtain a verbal verification of employment, we call it VOE in industry speak, and verify the borrower's source of non-employment income and obtain any other income documentation as required by the DU underwriting finding report. Again, what does that mean in English? That means that there's going to be no income documentation on these loans, with a caveat, which I'll get to in a minute. But if someone comes up with this DU or underwriting finding, which I believe will be the majority of the borrowers, all we're going to be doing is verifying verbally that the borrower is employed, and then not getting pay stubs, not getting tax returns, and the other things that we get now. And so really what they're looking for is an apparent ability. And again, if you read into their guidelines, their reason for this is that they say that the borrower is already in the Fannie Mae portfolio. They're already a risk to Fannie Mae. And so by not verifying that, they're not really doing themselves a disservice, which is sort of what people have been saying all along. If you're paying a 6% rate on the mortgage and you've stuck it out this long and now you're willing, they're willing to go down to a lower rate, they might as well make it a little bit easier. So I did say that there is one caveat to that, and that is unless your payment increases by 20%. And so if your payment increases by 20%, then you will be subject to verification of income. And the funny part is I had a lot of people say, well, why would I do this loan if my income, if my loan was going, or payment was going up 20%? And so, why would I bother to refinance? And so the real key with that is that if you have an ARM payment, an ARM loan, adjustable rate mortgage, your current payment may go up a little bit. So far, in all the reviews I've done, I've had nobody whose payment's going to increase that full 20%. The average loan rate I've reviewed on an adjustable rate mortgage right now is about 3.25%. And ironically, most of those, since the original principal balance was higher, and when they're going to have a new lower principal balance on the new loan, most of those, the payments are staying about the same when they go to a 30-year fixed rate loan. The other way that the payment might go up 20% is if somebody went from a 30-year fixed down to a loan with a shorter amortization. Again, I got a lot of people who've had their loan for 6 or 7 years, and they're thinking, hey, maybe getting a 20-year fixed rate loan would be a good idea. And so that's the other instance where it might go up more. And in the end, certainly if it doesn't make financial sense, we don't expect people to refinance. Another really great thing about it is the credit piece of this loan. For DU Refi Plus transactions, those with an automated approval, Fannie Mae is waiving the 620 credit score minimum eligibility requirements. Now, in reality, just because they say this on here doesn't mean that when we actually run somebody through Desktop Underwriter that they'll actually be able to get through. So this will be the one requirement that I kind of have a little bit of question mark about, but I really do hope that this is going to help people who are in those loans who may have had some credit challenges since then get a new loan with a lower payment. Another huge one is the removal of bankruptcy and foreclosure policy. Currently, right now, most of you know there's typically a few-year wait or more. If you've had a bankruptcy, short sale, or foreclosure, they remove that policy, and that's a great news for a borrower who currently has a primary residence that meets the other credit eligibility guidelines with a Fannie or Freddie loan, but may have had a rental property or a second home somewhere that they had to let go, or maybe they had to file bankruptcy recently, and now they're eligible for this program. Again, this is the right thing to do. I love that they decided to do this because this is a borrower that I think was going to be left out there in the gap, so to speak, and now they're going to be helped by this program. Here's the one other piece that's really important, because again, people are saying, well, how can someone have lower than a 620 credit score? Well, if someone's missed mortgage payments, if they were trying to do a modification or something else and it didn't work out, still potentially eligible for this loan. The big key is you have to be current for the last 6 months on the loan, and you cannot have been more than you can't have had more than one 30-day late in the 6 months prior to that. So basically, in the last 6 months, mortgage rating has to be clear, and then months 7 through 12, you can have had one glitch where you had a 30-day late. One nice thing is that this program is running through the end of 2013. So somebody who's currently past due on their mortgage, has been paying it, whether they're trying to get a modification or short sale or whatever it is, and decides to stay in their home, They can bring the mortgage current, start making their payments now, and still be eligible for the program before it ends. So again, I think this is another good rule that Fannie and Freddie have put into place. Occupancy is another big one. I got a lot of people who have purchased a new home as a new primary residence to take advantage of great interest rates now and great home prices, and they've got their old home that they're renting out, and that old house has that 6% interest rate, and they would love to save money, and they're all eligible. If it's an eligible property, if it's owner-occupied now, if it's a second home now, if it's an investment property, regardless of how it started, your property will be eligible. Again, another great thing that they've done. The previous version, if it was originally a primary residence and it became an investment property, it wasn't eligible. Now it doesn't matter what the occupancy was to start with. It is good to go going forward. My favorite question, interest rates. Everyone wants to know about rates. Now, one thing I'll say, and we'll talk about it, coming up, the D-Refi Plus program is really going to be starting mid-March. And so the one thing I can't tell you is where rates will be when we hit that point. But what I can tell you is I believe the government has an incentive to keep interest rates low. The bottom line is that it's an election year. They want this program to be the biggest success that they've seen for struggling borrowers or borrowers who have continued to make their payment and just want to get a current interest rate. So therefore, I believe that the government, who's continued to buy Fannie Mae and Freddie Mac mortgage-backed securities, will continue to do so. And so therefore, I believe that rates will stay in this relative low area that they're in. However, here's going to be the caveats that are going to adjust it to keep people potentially from getting quote-unquote today's best rate. They are not going to have what they call standard risk-based loan level price adjustments, LLPAs in mortgage talk. They're not going to apply. And so what that means is that currently, if you have a loan that is up to the 125%, they can have up to a 2% adjustment in fee for that loan. So what that means is if I quoted somebody a rate today of 4.125% and it had a 1% origination fee, if somebody who was participating in the current HARP program wanted that same rate, they would have to pay that 1% origination fee plus up to an additional 2 points that was a risk-based adjustment by Fannie Mae and Freddie Mac. And so one of the huge things that they're doing, as I mentioned before, people may go from a 30-year amortization and they may try to shorten that up and go to a 15 or 20-year fixed rate. And they're trying to actually encourage people to do it by eliminating those LLPAs, those adjustments to the rate. And so therefore, somebody who has way upside down will no longer get the worst rate than someone else who's currently buying a home today. They've reduced that to 0% for loans with 20-year or less amortization. That's really great. And I will say, though, that they're still going to be subject to risk-based credit score adjustments where as your score ticks down every 20 points below 740, there will be a minor adjustment in fee and or rate that are just normal risk level adjustments today. But bottom line, this is really good news. The cap on amortizations greater than 20 years, which really is going to be the 30-year fixed rate that I would say that almost all the clients I've talked to so far want to stick with, was reduced to that 2% I talked to just 0.75%. And so what that really means in English is, going back to my example before, if I quoted someone today who was purchasing a home with 20% down, a 4.125% rate, and I was charging them a 1% origination fee, or there was 1 point to get that rate, with this program that would go up by 0.75 points, and so the same rate would be available, but they would pay 1 3/4 points, or they would just trade that up for a higher rate, probably about a 0.25% higher rate, maybe 0.3%, depending on credit score. And so again, I think that's really great. What people don't want is if the best rate today is 4%, they don't want to pay the same fees and get a rate that's 5%. That's not really what the spirit of this loan program is. And here they've gone ahead and improved it by not pricing in the risk level that otherwise might be seen in this program. Bottom line is, again, rates will be really good on this. And I've been running all my scenarios with rates a little higher than where current market rates are and really doing my loan comparisons to see, okay, depending on where rates are, will it make sense for someone to refinance? And so far, 100% of the people who have eligible properties, it's made financial sense for them to do a refinance. So now we're kind of getting to some of the other questions that we've gotten. So second liens. So second liens, people, I always say, do you have a second mortgage? And people say, no, I have a line of credit. Well, this means line of credit, HELOC, home equity line of credit, second mortgage, whatever you want to call it. They are allowed, but they must be resubordinated by the current lender. That's done where you essentially get a letter from the current lender saying that they will allow the new mortgage to go in first position and they'll go in second position. I don't really anticipate this being a problem. I believe all lenders are going to participate with government pressure. I talked about loan to value before. There's also combined loan to value and then HCLTV for people with home equity lines of credit. And there's no limit to that either. So just like there's no limit on the front loan to value because of no appraisals, there's no limit on the back loan to value as well. Another big question is, though, can I combine my two loans in this program? I've got a first mortgage and then I've got a second mortgage or a line of credit. I would love to put them into one new loan. The answer is no. They're going to allow you to get a new first mortgage that lines up with your current first mortgage. And again, the reason is that the government doesn't want to take on any more risk than they currently have. They would rather leave the risk of that second lien with the current second lien holder. Can I remove my ex? Gotten that question a lot, or any other co-borrower. I've got a lot of people who've had a family member co-sign in the past or have been, for some reason, had somebody else on the loan, and that borrower can be removed without being requalified, meaning without income documentation in a full doc loan, as long as they've been making the payments from their own bank account for the previous 12 months. So if you are living with someone, you have a joint bank account, and you wanted to take one of you off the loan, you can't do that because you've been making the payments from a joint account. However, if you were previously married, I just had this happen with a client this week, and you've taken the house as part of the divorce settlement and you have your own individual account and you've been making that payment for 12 months, you'll be able to remove your ex off that loan or that other person off that loan without the requalification piece, with just the verification of employment we talked about before. Again, something else I think they did right and something I'm really excited about. Can I add a borrower? Yes. Plain and simple. I think the question is, would you really want to add a borrower? I would probably have to have someone twist my arm to convince me of that. But the bottom line is, if for some reason you wanted to add somebody else to the loan, you can. Of course, Fannie and Freddie would love to have somebody else be liable for your underwater mortgage, so therefore they will take that. Condominiums. Many of you know, as I see there's lots of loan officers and real estate agents on this call, that getting financing for a condominium right now is really difficult because they don't meet the eligibility requirements. And again, kind of going back to the reason that we said that Fannie Mae is not really doing full income documentation, they already own the loan. And so again, that's what they're saying here. Since the loan is currently owned or securitized by Fannie Mae, no further review is required, except the lender must confirm that the property has adequate hazard, flood, liability, and fidelity insurance coverage in place. So again, good news for someone who might have tried to refinance their condominium before, gotten a loan decline due to the fact that their condo project didn't meet eligibility requirements. Those people will be able to get financing now. What if I have a jumbo conforming or high balance mortgage? Many of you are in states who are listening where you have the super conforming, the higher loan limits. And yes, the bottom line is, if it was purchased prior to the June 1 date of 2009 by Fannie or Freddie, then you're subject, you can get a new loan subject to the current applicable loan limits, which we know after the little fiasco at the end of the year, they reinstated the high loan limits. So anyone who's got a loan with Fannie or Freddie would be eligible even for the high dollar market, which is great. Oh, the dreaded mortgage insurance question. Unfortunately, if you have it now, you will have it on your new loan. Side caveat, some of the current mortgage insurers that may be your current mortgage insurer may not be issuing new mortgage insurance, and they do have a system set up for that to continue on with your mortgage insurance. No need to worry. So of course everyone wants to know, where do I check my loan? And so we created a website. It went up yesterday. It's not really as complete yet as we'd like it to be, so keep checking back, but ultimately you can go to www.harp2program.com, and on there down at the bottom there's a link to both the Fannie Mae and Freddie Mac loan lookup to see if they own your loan and if it's eligible. Additionally, you can always fax or email us over a copy of your statement, and we can assist you with this check as well. I've talked to some people who unfortunately their loan is not eligible, so it is a bummer, actually a big bummer, and I'm just telling people send us your mortgage statement anyway, just in case something new comes out in the future. You know, I've had all these clients who've sent me their mortgage statements over the past couple of years who were over the 125%. Lo and behold, those were the first people I was able to contact when this program came out, because we had them marked in our system with what their concern is. And you never know, crazier things have happened. I don't anticipate that Fannie Mae and Freddie Mac will want to take on liability of other private issuers of mortgages. However, if they ever do, we want your information so that we can look at it. Additionally, if you have an FHA or a VA mortgage, keep in mind that FHA still offers the streamlined refinance mortgage where you do not have to get an appraisal. We're doing a fair number of those right now. And then VA has limited ability to do their interest rate reduction loan without an appraisal. And again, I say limited because it's not easily accessible. Not all servicers offer it, but certainly something that we would take a look at with you and do a mortgage audit, see if it's somewhere we can save you money. So the bottom line is, if you're not eligible, don't give up. Still reach out to us so that we can keep an eye out for helping you in the future. If your loan is eligible, awesome, right? That's what we want. So just go ahead and email us or fax us a copy of your current statement along with your contact information, and then we'll walk you through the loan process. The first part of that process, as I mentioned earlier when we talked about rates, is that it's all about determining whether or not the loan makes sense for you. So we do a quick spreadsheet showing your current loan versus what the new loan will most likely look like, so that you can make the determination. I've got a lot of people who do want to look at maybe a 15 or 20 year, see what that is, so we can compare the 30 year to your current loan as well as the 15 and 20 year to see making that new payment make sense. So that's the first step. If it doesn't make sense, then you're not going to do the loan. And like I said, so far I haven't found anybody who has a high rate that doesn't want to save money. It makes financial sense. The second part of the process is taking applications. We started taking them back in December, and we're going to continue to take those. Currently, again, our whole goal is to get people ready for this loan. It's going to be a huge success. As you've kind of seen, it actually makes sense. And so since it's going to be a huge success, we want to get applications going now. There's no reason to wait till mid-March when the automated systems are updated. We're getting applications today so that we can have complete loan files as we get closer. The next step will be the disclosure process. Once we pull credit, we've got 3 days to disclose on a refinance application. We're going to start doing this actually in February, and the reason is because then the credit report will be good for 90 days. It'll get us through all the initial rollout of the loan program. Since we don't know exactly what day Fannie Mae, Freddie Mac will have the systems ready to go. It should be by the 19th of March, but just in case they run late, or just in case they don't have the lender's back end set up on it, we want to make sure we have plenty of time. And so we'll disclose at that time, and then again, one step of the process out of the way earlier. And as most of you know, the disclosure process is a little bit daunting. It's 30 plus pages, sadly, but we'll go ahead and get that because that's one more thing we need in a loan file. And then really our goal is going to be close the initial round in late March to early April. And again, since the market's going to get so full of these loans, we want to be on the front end. And again, I already indicated that I anticipate that rates will stay low, but as we've seen in the past, when rates jump down or a new program becomes available, oftentimes lenders will increase rate to slow down the volume. So maybe mortgage-backed securities will stay low. Maybe the government will be doing their job to allow people to have low rates, but maybe the lenders will be increasing their rates to slow it down a little bit. So we don't want to risk that. I don't think that's likely going to happen in a huge way, but the bottom line is that we're going to be at the front end of it with our clients to ensure that we close early and we don't have to worry about that and just not have that interest rate exposure. What if you missed part of this? A few of you logged on late, so it will be available up on the harp2program.com website probably in the next couple of days, as long as I didn't mess it up, but I believe it's recording right. And so go there and visit it. Certainly we'll be posting it to our Facebook site as well, and we'll be emailing it out so that if you missed any part of this, or you've got any family and friends who you think would benefit from this, I know you do. And so we'll make that part available, and we'll probably run some more upcoming live seminars as well, webinars, so keep your eyes out for that. Certainly, as I said, you have friends and family who need to hear about this program. We truly value referrals and would love to assist you and your friends and family with a complimentary mortgage review. The reason that this is important is because we're a big fan of the program. I talked to a client last week who has a business banking account with a local or a national business banking company, and they said, "Is there anything else we can do for you today?" And he said, "If you could help me with my mortgage, that would be great." And they said no. And ironically, he's got a Fannie Mae owned loan that's eligible, and so there are people getting the wrong advice because there are banks that aren't going to be participating in this program. There are local mortgage bankers who are thinking today that they might have access to the program, but none of the conduits have said that they're going to do it. So really, primarily, it looks, at least at this moment, that it's only Fannie Mae and Freddie Mac direct sellers who may have access to this program. And if that's the case, there's going to be a lot of people who are talking to other mortgage lenders out there who are told they don't qualify, that there's no loan for them when there really are. So I'm counting on you guys to refer those people our way now, so that there's no risk of them getting the wrong advice or bad advice going down. And our commitment to you is we promise to take great care of them. And as always, we sincerely appreciate all referrals. All right, this is it. If you've got questions, now is the time. You've got a chat box to the right, so please go ahead and ask questions. If you are watching the recording of this, then listen, because someone might ask a question that may make sense to you. And so therefore, I believe that it'll be beneficial. But in this case, if you've got a live question, you'll need to pick up the phone and give us a call. So I got a great question from somebody that's how the HARP 2 program will verify independent contractor employment and income. For example, some of my realtors on the call. And it's interesting. It's not spelled out in the 29 pages of frequently asked questions that they've put out. So what I'm anticipating is it will be like the old days, and I hate to use the word, of stated income, or in this case it's going to be people appearing to have the ability to repay the loan. So I'm anticipating that they're going to go back to the old days of having some third-party verification. Typically that would be a CPA letter or potentially license, showing that you've got a real estate license, something along those lines. I will throw out there, many of you are familiar with what's called the 4506T. That's the tax transcripts where they do pull those on all loans currently to verify that what someone submitted to us with their tax returns and W-2s and whatnot matches up to their pay stubs. They will be pulling that on all of these loans, so it's not really a truly stated income loan because they're going to actually have access to what you really filed with the IRS. It's just not coming from you. And so they're going to look to see that is close. But again, since they're not looking at debt-to-income ratios, then that part doesn't matter. But I do know I've got already probably a dozen, probably close to 2 dozen applications in from self-employed people, and I have no doubt that there will be a loan for you. Okay, another great question is, will using this program hurt your credit score? I don't know that the word hurt is the right thing. Anytime that you have a hard inquiry on your credit, it's going to reduce your FICO score, your credit score. So, I view hurting your credit score is missing a payment on a mortgage or a car payment or a credit card. That is hurting your score. I believe going to the mall and applying for a credit card because you can save 10% on your purchase today, in 5 different stores, all those inquiries, I believe that hurts your score. But in the mortgage world, I think one inquiry to do this loan is not a negative. Yes, it will impact your credit score, but it's not. That should not be a determination at all in not going forward with this loan. And certainly, if you want to discuss your personal situation and why you think it may be a concern, definitely give me a call. Let's talk through it. Okay, someone's saying that they can't get the HARP website to load. It's HARP without an E on it. It's HARP2 program.com. You'll see it at the bottom of the screen, and it should be loading up. In fact, I'll type it into my browser on my other computer screen and see if it's loading up, but that'll be kind of embarrassing if it's not working, but it did work earlier today. Okay, it is working, so just retype that, and I think you will see that it's there. although it is loading slowly. So I'll take a look at that, but it should be up shortly if it is taking a little bit longer time to load. Maybe it's because so many of you are going there right now to check it out. Okay, someone else says it's working fine for them, so that's great. But bottom line is, if you have questions on it, let me know. All right, I don't have any other questions there right now. Anyone else want to throw up a last question before I go through just the last few things I think that are important for you to know before you get going? Okay, great question. Will using this program to refinance one house create any other issues with purchasing another home? I think the answer is maybe. I think if it's currently a home that you're not living in, then it won't create any issues at all. In fact, all it's going to do is make your ability to qualify for another mortgage even better, because it lowers the payment on the other home loan, and therefore it lowers your debt-to-income ratio. And so then on your current purchase you're trying to make on a full doc loan, then that's a good thing. In fact, it's a real positive. However, I think where the question mark right now, and I've actually put it out there to get an answer to, is if I currently am living in a home as my primary residence and I refinance it as my primary residence, how soon can I go out and finance a new primary residence? That's the answer that we're looking for, because I've got lots of clients who have eligible mortgages, and we currently have them pre-approved to go out and buy a new primary residence. And so we're going to determine whether or not we should refinance their current loan as an investment property, because that's what it's going to be soon, or whether we can refinance it as an owner-occupied property. That's the one of the remaining question marks we have. But in the end, I still believe it's going to be great. Someone said they didn't hear that question, so let me just say that again. If you're using this program to refinance, will it hurt your ability to buy a loan again in the future? And again, I believe the answer is really no. The only question mark being whether or not how the occupancy should be done on that loan. But the bottom line is, anytime you're saving money on a mortgage, that means that whatever you go buy is going to be even easier to qualify for, because your debt-to-income ratios will be lowered. I got a great question of, is occupancy required for a time period after the refinance? Again, that's sort of what we're looking into. We don't know if what that current, normally right now you're supposed to have a loan for 12 months before you move out of it to not violate the Fannie or Freddie guideline. We're trying to verify that now. So if you are one of those people who has a current primary but wants to buy something new within the next 12 months, send me an email or give me a call, so that as soon as we get that, we can let you know. We will put it up onto the website once we get it, but certainly let me know if it affects you, so that we can get that information to you as soon as possible. I've got another question. Someone is saying that they were told by their current servicer to call them back on February 20th, and wants to know if it's firm that the program won't be implemented till mid-March. Yes and no. So currently, I'm surprised that somebody's servicer is telling them to call them back. What that tells me is that servicer already has a lot of the current Refi Plus version in there. Again, I don't think the Refi Plus version, since it's a manually underwritten loan, is going to probably be the best route for most clients. I believe most banks, most clients will benefit from waiting till the March kickoff date. I would disagree with your servicer on waiting till February 20th. I would submit your information to us now. There's no reason to wait, because again, if you wait till February 20th, there's going to be such a long line at that point that you're going to be towards the back of the line and have more interest rate exposure than the people who do it earlier. And so I would encourage you to not wait on your servicer, to give us a shot to help you get the process started now. And then I do believe that the mid-March is an accurate date. Certainly that can change, but Fannie Mae came out with their update on that last week, saying that the weekend of the 17th of March is when they'll be upgrading their Fannie Mae desktop underwriter for this. And so we believe that Monday when we get to work, we should be ready to go. And in the past, they've been pretty accurate with that. Someone else is asking me, is that if your loan is held by a big financial institution, can we refinance it here at Cobalt Mortgage? We can, yes, as long as your loan is eligible for the DU Refi Plus version, meaning that we can get a desktop underwritten automated approval, which should be most of the loans that we see. I think it'll be 99% of them. Then we can refinance that loan for you regardless of who your current servicer is. In fact, You've probably heard me talk about it before. I believe that that would be a benefit to you to have us do it over your current servicer because of the fact of how we do business. One, will be tremendously faster because we've got a commitment to excellence, and unfortunately I believe that most of your servicers don't. The other is that we may have multiple sources to price the product where they won't, and the bottom line is that we want to help you. We want to help make sure that you're taken care of in the right way. We're licensed loan officers here. The person that you're talking to, unfortunately, making a little more than minimum wage on the other end of the line at your servicer, who was working in a call center and doesn't have any financial background, I guess you be the judge whether that's the best person to be giving you financial advice on your loan. Since there's going to be no additional cost to use us and we can do any of those loans that are out there, I would appreciate you giving us a shot at helping you out. Another question is this both for Fannie and Freddie? It is. It is for both Fannie and Freddie. Fannie Mae has put out more information on the program, and so what you see is a lot of my references in this webinar are to the Fannie Mae specifics of it. The stuff that Freddie Mac has put out has mirrored the Fannie Mae version of it, and I would say probably of the loans that we're reviewing, about 10–15% of them are Freddie Mac owned. The majority of them are Fannie Mae owned, but it will be a program that will work for both. Did get a great question on what costs are involved in the refinancing. It is like a normal refinance loan in that there will be title company fees on there, so you will pay for a new title policy. So that'll be a fee that you will get, and then there will be a lender fee charged. Our goal here at Cobalt will be to explore options for reduced lender fees. We'll be looking at options for potential of the quote-unquote no-cost refinances, where you might take a little bit higher rate than the best rate available, so that those fees are zero, and each one of those will be rolled in there. So we'll be taking a look at that. Someone's asking about prepaid items. So yeah, you will establish a new escrow account for your taxes and insurance, and that money you'll fund at the close in your funding, and then you'll get a refund of it typically within 30 days from your current lender. And again, what we'll be able to do is once we get your mortgage statement and we learn more about you and we do your analysis, we'll be able to look at it. I've got a lot of clients who don't have any cash that they can use to pay at close, and so we'll have solutions for most, if not all, borrowers where they can come in with little to no cash. Most borrowers will skip at least 1 month's mortgage payment on it, and then everyone's going to get that escrow refund. And so there will be some people who set this loan up in such a way that it actually helps them out financially from a cash perspective, meaning some people who do the refinance today may have more money in their pocket a month down the road than if they hadn't done the refinance, depending on the timing. And so we can give you an estimate on what the out-of-pocket costs will be, how the different ways you can structure your loan are, and I think that is going to be one of the things that's going to help. People get this done. And I will say this: when it comes to the disclosure piece, which we'll start doing in early February on the loans, that disclosure piece will have exact costs on the loans. We'll use true costs. We're not going to use fake costs that are low and then surprise you with higher costs at the end. We'll use real costs on that loan with estimates for interest rates, since we won't know where the rates are at that time and won't be able to lock them. Okay, any other questions before I just move through the last couple of slides on the show? All right, that looks like maybe all the questions. If you have additional questions, please don't hesitate to shoot me an email or give me a call. I would love to help you. Again, I want to say just thank you very much. I really appreciate you taking time out of your busy day to watch this. Here's our phone number on the screen. Love to talk to you about it. There's also a direct email that goes to myself, Todd Bookspan, my wife Tara Bookspan, and Matt Baker, my partners on the Bookspan Baker team here at Cobalt Mortgage. We would love to, again, help you and any other referrals that you have with regards to this program. Of course, I did want to go through what the resources are. So there's Fannie Mae and Freddie Mac's direct websites. Again, our HARP2program.com website, which is our version of it. We'll keep people up to date on any other changes. And then here's that long link to the Fannie Mae 29-page frequently asked questions for any of you who are nerds and want to read the fine details on it. And then, of course, since I'm married to an attorney, here's my disclaimers. It was recorded on today, January 14th, 2012, certainly they could change the guidelines between now and when they roll it out. You've certainly got to meet the eligibility requirements discussed, although it doesn't guarantee that you will qualify for the HARP 2.0 refinance. Here's all of our contact information for our corporate and my NMLS ID. Again, I just want to say thank you very much. I would love to talk to any and all of you about this program, and appreciate you again taking the time to watch this, and appreciate all of your referrals. Thanks, and have a great day.